So what we have in front of us is a comprehensive technical analysis report on the QQQ trust. It's all centered around this powerful 90% upside signal for potential year-end breakout.
Right.
Okay, so what I really like about this piece right off the bat is just the incredible clarity. The focus of the initial analysis is razor sharp.
I agree.
The write-up, it immediately gives you the key technical levels. There's a concrete stop loss at 618, and it does a great job interpreting yesterday's V-shaped recovery.
Validating that 620 support line.
Exactly. It sees it as strong institutional demand, which feels right. The whole structure is focused, it's professional, and, it feels highly actionable from the get-go.
It does.
Which I think leads into the first big opportunity here. So a key theme running through this whole thing seems to be this reliance on historical probability. Specifically that aggressive 90% signal.
Yeah.
That's derived from reclaiming the 50-day moving average in Q4. And that is a massive, massive claim to lead an analysis with.
It is. And I think the persuasive power of that core 90% signal can be significantly bolstered just by providing some explicit context for its historical calculation.
Okay.
The weakness here is pretty substantial. The analysis asserts a very strong, specific probability, 90%, for a continued uptrend over the next 30 days.
Right, it's the hook.
It's the entire hook. But this foundational claim is just presented as a singular fact. There are no specific data points, no timeframes, no mention of the backtesting methodology within the report itself.
Right. So that number is the biggest piece of bait in the entire report, but it's sort of sitting on a logical void. It creates a critical trust gap, doesn't it?
It does. The most aggressive and, exciting claim rests purely on an assumed historical pattern.
And if you're a sophisticated investor reading this, you might feel like you're being sold the probability instead of being shown the proof.
Exactly. You start to question the rigor of the entire analysis.
Yeah.
Precisely. If that 90% is the engine driving the conviction, we need to see the engine. The suggestion, I think, is pretty straightforward.
Okay.
Just integrate specific comparative data points, or even just a very brief summary of the look-back period. That would validate the signal's historical reliability.
Uh-huh.
And doing that, it instantly elevates the analysis from just a strong hypothesis to a documented strategy, which is critical when you're making claims this aggressive.
I love that idea of using minimal space for maximum impact. You don't need a 10-page appendix on backtesting or anything.
Not at all.
For example, you could just include a parenthetical note within the explanation of the signal itself, stating the look-back period. Something super crisp, like, based on QQQ performance since 2000.
Or even excluding recessionary cycles. That tiny addition adds decades of rigor instantly.
Right.
Or you could focus on more recent memory, briefly referencing the outcome of the signal in just one or two specific past years. That grounds the probability in something tangible.
Something we can remember.
Exactly. You could write something like, the last occurrence of this signal in Q4 of 2018 led to a 12% rally in the following month. That kind of sentence confirms its predictive power in a similar setup. It makes that 90% claim feel immediately justified and, earned.
It's earned. You're not just taking their word for it. That small change transforms the piece from, trust me, to, here's the data.
Exactly.
Okay, now let's pivot slightly. The report is very clearly framed as a technical trade. It's all about price action, support levels. But let's look closely at that section on fundamental catalysts.
Yeah, I noticed that too.
It includes things like tech strength, NVIDIA, Apple, Microsoft, and then, year-end seasonality, the whole Santa Claus rally idea.
That's clearly laid out, but I think the implementation is where the real opportunity is. Refining the connection between that short fundamental section and the overwhelmingly technical thesis would create a far more comprehensive and frankly defensible report.
Okay, so what's the weakness there?
The weakness we see is that the report notes, this is a technical trade, but then it lists these fundamental factors almost in a vacuum.
Ah.
They aren't actively linked to the specific technical levels or the targets or even the timing of the trade.
So it feels more like a standard checklist. Like, oh, and by the way, tech is strong.
Yes, exactly that, rather than integrated evidence. And this diminishes the synergistic strength of the whole argument.
It makes those fundamental points feel like an obligatory appendix instead of integrated support for that high-end technical target, which, in this case, is that pretty aggressive $650 projection.
Precisely. If this is a technical trade, the fundamentals have to justify the aggressiveness of those technical targets.
So what's the suggestion?
I suggest framing the fundamental factors not just as general support, but as the engine. Or, the specific justification for that medium-term 650 price target. They need to actively interact with the technical structure you've already established.
So we're asking the fundamentals to actually pull their weight and reinforce the technical argument. Is that right?
That's it exactly.
Instead of just listing tech strength as a general concept, you could connect it directly to the floor of the trade. For example, something like the successful defense of the critical $620 support is fundamentally validated by the sustained relative strength we're seeing in top holdings like NVIDIA.
Yes.
This provides structural floor stability because institutional flow is actively holding those large cap names. That shifts the whole argument from just a passive observation to an active justification.
And building on that, you could use the seasonal context, the Santa Claus rally, to justify the forecast's velocity.
The speed of the move.
The speed of the move. So instead of just saying seasonality exists, you merge the timing argument. You could say, if the widely expected Santa Claus rally combines with this breakout, the technical goal of $650 becomes the path of least resistance.
I see. So you're directly linking the seasonal tailwind to the technical target?
You are. It underpins the historical December flows and provides a tailwind that justifies the speed of the whole move.
That makes the fundamentals work so much harder for the report's message. It lends credibility to the projection that 650 isn't just a technical possibility, but it's a path that's being accelerated by known market cycles.
Exactly.
It's about blending the why, the fundamentals, with the how, the technicals.
I agree. That tighter integration makes the technical target feel earned. Now let's move to what I think is the most critical area for actionable advice.
Okay.
I can see what the writer is going for here, especially with the title of the report. It's called 90% Upside Signal, QQQ Technical Analysis and Breakout Alert.
It's a powerful high-momentum title, a fantastic hook. It's designed to grab the attention of a trader who's looking for a decisive move.
It really is. It signals urgency, high probability of follow-through.
Yeah.
And that's why we need to focus on strategic alignment here. To fully capitalize on that high momentum language, the action plan has to introduce explicit entry strategies for a move through the resistance zone.
Right. Because right now, the action plan for investors is 100% focused on the conservative buy the dip strategy.
In that 621 to 624 support range.
Yeah.
And that is the critical weakness. Buying the dip is, inherently a consolidation strategy. It manages risk during a potential pullback before the breakout.
Scenario that's implied by the breakout alert title.
Not at all. It doesn't address the specific 628 to 630 resistance ceiling that was identified earlier in the report.
It's a classic situation, isn't it? The report sets up the possibility of this thrilling speed race, but then it only gives the reader directions for navigating the parking lot.
That's a great way to put it.
If the breakout actually happens, the investor is left with no clear execution strategy from the analysis itself. They have to invent their own plan for the most explosive scenario, which sort of defeats the purpose of an action plan.
It completely defeats the purpose. So the suggestion then is paramount. Introduce an additional, clearly defined entry strategy that is contingent upon a sustained close above the immediate resistance. This provides a risk-managed plan for that high-momentum scenario. It ensures the analysis report fully delivers on its breakout alert promise.
This is the difference between writing an analysis about a breakout and writing one that gives actionable steps for the breakout itself.
Exactly.
For people who might not be as familiar, why is it so crucial to have a separate, explicit plan for a breakout entry versus a support entry?
Because the risk management is fundamentally different. When you buy a dip, your stop loss is usually below a strong, proven support level, a floor.
Right.
When you chase a breakout, you're buying into momentum, and you're relying on the broken resistance to flip into new support.
A completely different dynamic.
It is. If you don't define the entry and the stop for that scenario, you are basically inviting emotional decision-making. And that's the antithesis of a structured analysis report. The report needs to guide the reader through that psychological shift.
That clarifies the necessary complexity. So, how do we integrate this practically?
You should add a new dedicated section or a bullet point to the action plan. Title it something like High Momentum Breakout Strategy. This immediately aligns the recommendation with the title.
And then you detail the scenario clearly.
You do.
Can you give us some concrete framing for what that new section might look like?
Absolutely. It needs to be precise. For example, aggressive breakout entry. If QQQ registers a confirmed daily close above the strong $630 resistance zone, consider a specific entry point, say $630.50, at the opening of the next day.
Okay.
The crucial stop loss must be defined below the newly broken resistance, say at 627, validating the immediate run toward the next target of 635.
I like defining that specific level, 627, because it immediately tells the reader we expect the former resistance to hold as new support.
Yes,
That structure provides the same level of calculated risk that the buy the dip strategy offered, but it's tailored for high velocity.
and that alignment between the action and the title's bold promise, the breakout alert, is key to maximizing the report's impact.
And that detail, that specificity, is what makes an analysis report feel complete. You've prepared the investor for every major scenario, consolidation, and now acceleration.
Exactly.
So, as I understand it from the notes, the argument here is that this is a very strong, highly actionable report. It shows deep expertise.